Okay, thanks for those who got here early. We're just opening it up, and the system is allowing people in to watch. So we'll get started in about 1 to 2 minutes. It's great to see some familiar names who have joined us and some not so familiar names who have joined us. So we'll get started in just a minute or two.
Welcome to everybody.
Now, Steve, don't go running off to look at the Leafs game now.
I'll try my best. That's why I got Daryl Siller behind me. He's keeping me company.
Yes, we noticed that. Okay, the system's just letting people in, so we'll wait another minute and not longer than that because we do want to respect your time. So.
We can start trivia with favorite Maple Leaf captains if we'd like. Yeah,
that's a question that anyone who wants to stay after. We have a few.
Okay, we'll have trivia. We'll have Leaf trivia after. Yes, absolutely.
My Leafs trivia question that nobody gets. Yeah.
Well, Gary, maybe you can ask it now, and then you can have people make
we could make that one of the questions throughout. Okay, so when I was in grade 6, there was a kid in grade 5 in my tiny little school who went on to become captain of the Toronto Maple Leafs.
Wow.
Mm-hmm.
That's impressive.
And nobody guesses who it was because the Leafs were so bad when he was the captain.
I thought I guessed it after a couple of tries.
Let's see if we got any answers.
We got one answer.
Dr. Lenny, I'm not that old. No, okay.
Who do you say? Dave Keon? No, that was Murray.
No.
All right, Les.
Yeah. You know, it is amazing that nobody gets it, or not usually, right? Because the Leafs were so bad when he was the captain that people forget about.
I'll give them a clue. Think big, lumbering slap shot.
Yeah. So. Hap day. Yeah, no, nobody gets Rick Vive, but yeah, no. Rick lived a few doors down from me. And yeah. Okay, let's get started with that. So welcome everybody. Welcome everyone to the 4th of the TMFD Academy webinars. Steve Farronato will be speaking this evening. And we want to thank Steve for getting away from his Leafs tonight to come here, although they are playing the Rangers, and the Rangers have a pretty good coach, and they're off to a great start this year as well. So, Steve, you might be better off here versus watching the game and getting frustrated with as the Rangers take over there. Steve, as many of you know, has been the cornerstone of TMFD for quite some time. Been here 27 years, I believe, Steve. And Steve started off as the accountant in TMFD. And now leads a group of about 10, and is still the best. Is still the absolute best. Everybody knows Steve. He's done so much for so many clients over a long period of time. Before I turn it over to Steve, there will be a couple of questions that will come on the screen. This allows Carla's with us as well this evening, handling technology. This allows Carla to be able to validate for CE credits that you have been here. So please stay to the end for CE credits, and please answer the questions. If there are any questions for Steve, the request is to put them into the Q&A, not the chat, but the Q&A, and Steve will address those at the end. If there's any technical issues at any point, you can message Carla on that, and we'll take care of that. And I believe that was it, Steve. We'll turn it over to you, and we'll do a quick wrap up at the end.
Okay. great. Let me see if I can share my screen. That there, share. I'm gonna go on the PowerPoint presentation. Hit that. Try that again. Does that make it? Okay, there we go. Hopefully everyone can see the screen. All right, so tonight, I thank you for your time. I'm going to try to keep it within an hour, not for selfish reasons, but some wise man once told me that more than an hour and eyes start to glaze over. So I will try to keep it within an hour, and hopefully there's some questions at the end. There will be some numbers. That's just who I am. I'm a number crunching kind of guy, so there will be some numbers for the numbers people. But mainly it'll be a chat and discussion about various topics regarding selling your practice. No point on the intro here. Most people have known I've been with the organization for 26, 27 years. The only thing maybe some people may not have known that before joining the group, I was a couple of years with CRA. It was an interesting time, and I still use the information today, so it was helpful. Just a couple of housekeeping tips, and maybe Carla will add a little bit more towards the end, but the book that we've been promoting for so long is now available, The Financially Independent Dentist. So I encourage you to follow directions on the screen here, visit our website, give us a call, hit the social media sites, and subscribe for the book. A quick little shameless plug for TMFD Financial, of which I am part of as the tax and the accounting arm of the diagram here. We ultimately enrich the lives of our dentists and their families by providing a comprehensive set of accounting, financial planning, and consulting services through one point of contact. We have accountants, we have financial advisors, we have dealings with estate lawyers, practice consultants, a little bit of a one-stop shop to make your lives a lot easier. All right, a couple of things that we're going to talk about tonight. So before you think about selling your practice, so one of the things we talk about is practice valuations. Once we've determined that we're going to sell, then the question becomes, how do we sell the practice, whether it's sold by selling assets or shares. People have heard of the capital gains exemption, and we'll talk to you a little bit more about what it's all about and how to qualify for it. How do I get my family involved? Through income splitting, capital gains exemption multiplication, salaries, dividends, a couple of things. What does it mean to purify my PC? That terminology has been out in the marketplace or out in courses that people have attended to, and you'll hear a little bit more tonight. Latest and the most topical is this BCC 208, which talks about intergenerational business transfers and how to pass your practice on to a child, and the advantages of doing so. And what is a discussion about financial concerns when you don't talk about non-financial concerns. So we'll talk about a little bit of those towards the end as well. All right, so practice valuations. A couple of things we'll talk about, and we'll get into at the end an example on a quick and dirty method on how to evaluate your practice today. Save yourself a couple of dollars in terms of getting a valuation done. However, I do recommend at the time of a sale that a full valuation is done by a third-party broker. But I'll give you a quick and dirty lesson on how to do it relatively quickly. Buyer's market or seller's market? I mean, that could be a question that we could raise right now, but it won't be. But what I've seen, even post-COVID, I still believe it's a seller's market. I think there are plenty of opportunities for people to look at practices, and the bidding wars are still there. And three main factors that I look at, or a couple of factors I look at as to why I think it's still a seller's market. Interest rates still appear to be low. Prime rates are still at very low rates at 2.45%. A lot of the banks are lending even at lower rates than that, at prime minus a quarter. So it makes it very attractive for buyers and sellers to sell. They are graduating more students every year at the universities, and the entrance of foreign trained dentists and the exam process, which I understand is becoming a little more challenging, also floods the market of newer dentists. Thus, you have a large demand for practices, and the supply of practices is still relatively low. So those are the three things that I think really push a seller's market. A number of recent practice sales that I've been involved with, I've definitely seen appraisals and bids that are going above appraisals and bidding wars. For well-run practices with good numbers, you're still seeing that. Methods to practice valuations. When we first started dealing with the dentist about 15 or so years ago, the methodology used at that time, a rough rule of thumb, was anywhere from 50 to 75% of your annual production was a going rate or bid for practices. That's obviously changed over the last number of years, as we've seen it go to 1.5, even 2 times annual revenue. And that's one method of determining what practices are worth. A more typical method, and one used by banks or practice valuators, is a cash flow or an Ebitda multiple. A lot of people may have heard the terminology Ebitda multiple. Ebitda stands for earnings before income taxes, depreciation, and amortization, for the official acronym. So those are your two main ways of the way practices were being evaluated. The effects of COVID and how it's how it's affecting valuations. Up until a little while ago, when some of the valuations were being done, a lot of the brokers were carving out the 3 or 4 month periods while COVID was in existence, and sort of doing prorations and extrapolations of previous numbers. Now that we are, almost 18 months from the start of COVID, but maybe 12 to 16 months post COVID, the numbers are starting to look a little better, actually closer to the prior COVID results. So I think initially in the beginning, what we saw were some practice sales that had some stipulations in there, had some holdbacks, wanting to make sure that the numbers came back to a relatively normal number. And finally, we talk about the dreaded word, corporate dentistry. I just joke when I say dreaded word. I mean, there are a number of people that have looked towards corporate dentistry and have been happy with the results. In Canada, it's still a relatively low percentage. I think it's still maybe under 5% of practices are corporately held. I think in the US or across the border, it's closer to around 15, 20%. I think, as with most things, a lot of things tend to shade towards the US. So I think we'll see it happen more and more in the coming years. I think it provides those that have a need for or want to maybe retire a little bit earlier or take some upfront cash, but still want to work. The corporate dentistry might be the route for you. It's not for everyone, but it definitely adds and has some advantages. What I'm going to do next is share with you a quick and dirty calculation as to how practices are valued. For some of you that may have seen, this is we call it our TMFD model, which is a sort of snapshot of your profit and loss statement from your financial statements. And we've sort of broke down the various categories in terms of having one number as professional revenue. We've broken it down between the dentistry, the lab, and the hygiene revenue. And you'll sort of see afterwards as to why that's important to break down. And then your expenses are pretty typical as the ones that you see on your profit and loss. The only difference, what we do here is we sort of isolate towards the bottom. I'll sort of circle it with my mouse, is the compensation that's paid towards the dentist and family members, right? And that's sort of not typical of the calculation of the future value of the practice or the EBITDA number. So we tend to sort of highlight it. And this ultimately will show you this particular practice for our good Dr. Smith, who's referenced throughout the presentation, has a well-run practice where their operating expenses are very close to a very, very efficient model. Salaries and dental supplies being the two biggest costs are ideally in line with the model. And ultimately, the better those two numbers are in terms of how close and aligned you are to the model, the better the value practice will be. All right, so let's take this information and go on to our calculation of what this practice could be worth. So we start with this 352,000, which was the net income before taxes. So if we go back here, you'll see on the bottom. What we do in order to normalize earnings, look at items that are not typical in a dental practice, or in order to determine what proper cash flow would look like. So you add back various items. You add back amortization. The amortization, as you know, is a non-cash number. It's the wear and tear of your equipment. It reduces your profit, ultimately makes you pay less taxes, but it's not part of your cash flow. We back out things like automobile and dues and professional development. These are all considered personal expenditures and not part of a typical dental practice operation. That being said, when you own a practice, you end up running these expenses through anyway, but from a valuation perspective, they are not shown as part of the normalized earnings. And that last number was the one we talked about earlier, was the family salaries of 190,000, which was paid to the Dr. Smith and his spouse. So ideally, the normalized earnings for this practice was about $600,000 or just over. What we need to do in order to determine a normal full practice number is now we have to pay a dentist for the work that is done. We've paid everyone else. We've paid a hygienist, we paid the assistants, we possibly paid an office manager, but we haven't paid the dentist. And for, I guess example purposes, we show the percentage paid out at 40% of the dental revenue. And if you remember, I'll slide back up, the dental revenue was the 750,000. So it was a 750, not including the lab. So 40% of the 750 is the 300. And then we get a number ultimately of about $300,000. Now, here's where the math comes in terms of the multiplication and the multiple number. I've shown three different levels, 5, 6, and 7. A lot of, I get say, valuations lately have been around the 6 times multiple. And the factors that determine whether the number goes higher or lower, it depends on how well the practice is run, location, staff contracts, leases, things that ultimately make the future predictability of cash flow a little more consistent. Because ultimately, that's what you're paying for. You're ultimately paying for the recurring revenue stream to happen. That's what any buyer is looking for, even a corporate buyer. They're keen on that multiple number and that normalized earning number. So in this particular case, a very well-run practice could sell potentially at 7 times or $2.1 million. We've seen practice valuations even up to 8 times. Rare, but those are very, very exceptional practices that have got a very good growth potential. Let's say there's a lot of things that maybe are not done in-house and are farmed out or referred out. But if there's opportunity to ultimately bring a lot of the dentistry in-house, then there's potential and can ultimately increase the ultimate value. So this practice that generates $1.2 million of revenue could potentially sell for just over $2 million. So that's not 2 times revenue, but more than 1.5 times. So hopefully that gives you a quick indication as to how you can run a quick little what's my practice worth illustration, just to give you a sort of peace of mind if you're looking to do that. But as mentioned earlier, obviously, if you're looking to sell and put the practice on the market, whether you want to do it with an associate internally or sell it yourself, you still need a valuation to be done. Banks are still looking for third-party independent valuators. The dental, corporate dentistry ultimately does not care so much for your appraisal. They do their own internal appraisal, and I've seen a number of their methodologies, and they use or follow a similar multiple of earnings calculation. All right, so we've determined that our practice is worth $2 million. And now we say, okay, I'm going to put it on the market, and I have 2 ways to sell it. I ultimately want to try to sell the assets of the practice or the shares of the practice or your professional corporation. There are advantages and disadvantages to either. In a share sale, you ultimately sell the shares of your corporation. The corporation no longer exists after it is sold and is generally amalgamated with a purchaser corporation. In an asset sale, the professional corporation remains intact. The buyer ultimately buys the equipment, goodwill, meaning the major portion of it, or I'll call it the patient list, but the ultimate company stays intact. Tax implications, and this is where the biggest advantage or disadvantage comes into play. When you sell the shares of a professional corporation, you are ultimately utilizing capital gains treatment on the sale of those shares. And when you're selling a capital gains treatment, only half of the proceeds are ultimately taxable. When you are selling assets, it's a different story. You are having different components of the sale, some of it being goodwill, some of it being hard assets, and they have different levels of taxation involved. As mentioned earlier, the main reason for a share sale is the ability to have the capital gains treatment, and 50% of it is taxable. The biggest, and you can circle it if you want, that reason why most people sell shares of professional corporation is where ultimately, if they qualify, and we'll talk about the qualification process in the next couple of slides, but if you qualify, there's ultimately about a $900,000 capital gains exemption. So the first $900,000 of this particular $2 million sale is ultimately tax-free. And we'll talk about it a little bit later, but if there are family members that are shareholders as well too, then you can multiply that capital gains exemption amongst the family members. All right, but you have to make sure that things are properly set up. We're going to go through a little exercise at the end of this section where we compare an asset sale versus a share sale. And you'll see that the differential could be potentially quite large. So from a buyer's perspective, when you are looking at buying shares, you're ultimately, as I indicated, buying the corporation as is. And you may have a corporation that has written off or worn down the assets of the corporation and utilize all the depreciation. So you're not really gaining much ground when you acquire that new corporation. Whereas when you're buying assets, you could almost reset the clock. And if you allocate some of the purchase price towards some of those hard assets, the equipment, the leaseholds, then you can ultimately restart your depreciation clock and get some tax savings. As mentioned earlier, one of the key sort of disadvantages of selling the practice through the asset sale is that you could ultimately have a situation where you are paying double taxes, and that you are first selling the assets or capital or goodwill within the practice, and then you have to determine ways to get the money out of that corporation, because ultimately you need to pull the money out to sustain a lifestyle or retirement. So you need to be mindful that there's going to be some taxes involved at pulling that money out. I think a lot of the times what we ultimately say is that that price that I indicated earlier, that $2 million price, whether it's an asset sale or a share sale, I think you have a little bit of a leeway and flexibility to charge a little bit more on an asset sale, just because the buyer might be willing to pay a little bit more because they know they're going to be able to write off some of the depreciation of the equipment that they've now been able to sort of recreate a higher base. So there are some advantages, and buyers are willing to spend or pay a little bit more. And ultimately, I think we've said that, as I said here, you can step up the tax base to acquire those assets. One of the keys in an asset sale is the price allocation and how much you are going to allocate. So let's say in this particular case is a $2 million practice. How much of that $2 million are we going to break down between, we'll call it sundries, between equipment, leaseholds, computers, and the major part is the client list or the goodwill. The more you allocate towards the goodwill from a seller's perspective, the better it is for the seller, as they will have capital gains treatment on the goodwill. If you have more allocated towards the equipment, the purchaser prefers that, but the seller is not as interested for two reasons. They might have written off those assets, and now you have a tax terminology called recapture, which is the depreciation ultimately that you've claimed in the previous years that you'll have to recover back and add into your income when you calculate the tax on the sale. So there is a bit of a negotiation that takes place between buyer and seller, and accountants are generally involved to determine we'll call it, there's a saw off, or there's an in-between number where both parties are relatively happy. Okay, this is for you, Murray. It's a little eye glazing, but it's a lot of numbers. But ultimately, what we're trying to show here is, what is this practice ultimately worth to the individual after selling the shares and the assets. And we're still ultimately using a price of 1.5 million for both asset and share sale, despite the fact that I said you could probably get a little bit more on an asset sale. But just from an apples to apples comparison, in this particular share sale above, $1.5 million, your ACB on the shares is ultimately your start of your corporation, where you maybe paid $100 for your shares. Your capital gains exemption, as we mentioned earlier, is rounded for argument's sake to about 900,000. You have taxes to pay at the top marginal rate, so you're looking at about 159,000. And ultimately, in your pocket on the 1.5 million, you have about 1.34 million bucks. So we say, well, how does that compare to an asset sale? So now, as we talked about a little earlier, the allocation of this sale price of the 1.5 million, as you see, we had dental equipment, furniture and fixtures, computer, leaseholds, and a good chunk of it towards goodwill. We've made the assumption that the book value and the fair market value on these hard assets are the same, so we don't have any recapture. It's could happen, but I generally see it that most practices, unless they've remodeled and were able to bump up their cost base on some of the equipment, there might be some recapture. But for argument's sake, we assumed it to be the same. We showed goodwill at the 1.25 million and the taxes that are involved. Initially up front on the sale of the practice, you'll see it is a bigger number of about $300,000. However, the corporate tax system has something called a refundable tax. And as we draw money out, as we talked about how we draw money out of the corporation to ultimately fund your retirement, as we draw money out, you get to recover some of this tax, and it's a refundable tax. So ultimately, you're looking at about a 20% amount of tax to pay on the the goodwill component. Now, we want to make an apples to apples comparison to say, well, I need to get this money out of the corporation. How much tax am I going to pay to pull this money out of the corporation? And I've given you a couple of examples. Well, one main thing that comes to mind here, maybe not too many people are familiar, is with the concept of the CDA account, the capital dividend account. And this is a sort of a hidden gem that not too many professional corporations or corporate owners are aware of. But in this particular case, it is the non-taxable component of a capital gain. So the capital gain on the sale of this goodwill, which was 1.25 million, half of it is taxable. The other half flows into a CDA account, which can ultimately come out of the corporation tax-free. So immediately we have the ability to pull out 625,000 tax-free. The balance, which is available for a dividend, the 750,000, this is where the planning comes into play. And where if we can afford to take some of these dollars out of the corporation over a period of years and use that to help fund your retirement, you will see that the amount of tax that you pay and the amount of proceeds, net proceeds, start to become more and more comparable with your net proceeds above. So if you want a pure apples to apples comparison, say, I want the same dollars in my pockets the same day I sell as I sell the shares, then you'll see at the bottom the difference being the $300,000, which ultimately is your capital gains exemption that you were entitled to on that 900,000. That's your biggest advantage. However, you'll see if we go down to a point where if we can stretch this to a point where we're drawing out maybe $75,000 to $100,000 in dividends a year, your amount of personal tax gets reduced, and the total amount of tax that you pay is lower, and the differential is, it's about 37,000. So it's not a big difference between the two. So it's not always the be all and end all to sell shares. If you can do some planning, maybe you've used up your capital gains exemption in the past. Maybe you don't qualify for the capital gains exemption, and we'll sort of go through the examples as to why someone may or may not qualify. Be aware that you have some planning opportunities to try to reduce your tax. All right, question number 1. And Carla, maybe you can help out here. That's come up on the screen. Thanks very much. So rounded to the nearest 1,000, what is the capital gains exemption limit for 2021? So it's either A, 500, B, 900, C, 750, or D, $1 million. So we'll let it go for a little bit here to see where things go. I'm glad a lot of you are listening. Thank you very much. Or you just know it, which is great. We're seeing that a majority, we're up to about 90% of the respondents have said B, $900,000. So that's great. Thanks very much. So thanks, Carla, for showing that. And we'll stop sharing that. There's your results there. So over 90%. Get that off the screen. Okay. All right, capital gains exemption. Many rules, but I've narrowed it down to 3 tests. And if you can take anything away from the presentation tonight, you want to be able to make sure that in order to qualify for your capital gains exemption, you want to make sure you meet these 3 tests. The first one is there's a 24-month holding period. You must own the shares for at least a 2-year period. Okay, there is a bit of a, I'll call it a loophole, but if you still are not incorporated, and we still have a number of dentists that are not incorporated and are still sole proprietors, you have the ability to incorporate prior to the sale, create a corporation, roll those shares and the practice into a corporation, and sell the shares thereafter and still qualify for the exemption. So keep in mind that it's still available to you. The next 2 are more numerical, but are important. So at the time of sale, so the day before the sale takes place, and you look at your financial statements, 90% of the assets of the PC need to be actively used in the business. So what does actively used in the business mean? It has to be the day-to-day operations. If you've bought equipment, you've got payables, receivables, having a fair amount of money in your bank account, of which is not actively being used in the business. So maybe you need 1 month's worth of production as cash flow to help with payables and payroll and sundries and rent, that's fine. But if you end up having a significant amount, some people are holding $500,000-$600,000, or some people started investing inside their corporation because the corporations have provided us the ability to leave money behind, because that's the biggest advantage of the corporation. Lending money to another corporation, a related party, and using that corporation as an investment corporation does not alleviate you from this 90% test, because ultimately that simply shows up as a loan. The dental structure, as most of you know, does not allow for a holdco, opco situation where you have a holding company owning the shares of the professional corporation. Unfortunately, the shares of the professional corporation need to be owned by primarily the dentist. Family members can be shareholders, and we'll talk a little bit about that a little bit later. But the 90% test is an important test. The second test is a 50% test and a 24-month period. So for the 2-year period prior to the sale, you can't have more than 50% of the assets not actively used or actively used in the business. So depending, again, how much you have decided to or had the ability to save inside the corporation or lend to another corporation, you need to do that calculation and determine if you are on side. So when we're telling our clients to think about selling their practice, we always talk about this 2-year rule as to think of at least 2 to 3 years ahead of the game, because if you are offside and you're within a year of selling because you've had enough and you want to get out and you don't meet this test, then unfortunately you don't qualify for the exemption. I have a little example here where we're going to run the analysis. This assumes that our Dr. Smith's already met the first test and that he's been in practice for a couple of years. But here's a typical balance sheet for a practice owner, maybe that's been around for a couple of years, has ultimately paid off a majority of their practice debts. You'll see here they've have some short-term investments. They've lent money maybe to another holdco or another investment company. So between the two of them there, you're close to $500,000 of, we'll call it non-active assets. The bank account at 75, accounts receivable, the prepaids, they're ultimately offset by the payables, the income taxes, the current CEBA loans, and some shareholder advances. So if we're looking at if we qualify or not, I'll run a little bit of a matrix here and say, okay, the first question, 24-month holding period, we've assumed so that they've been around for a number of years, so they automatically qualify for the 24-month test. The next test, the 10% and the 50%, we're assuming that the fair market value of this practice was $1.5 million. So that comes into the calculation of the 10% and the 50%, right? So if the fair market value of the practice is 1.5 million, we said the passive assets or the non-active assets, if you recall, I'll scroll up a little bit, which was the 425 in your short-term investments and the due from related party, that gives you your 525. So the total value of the corporation is worth $2 million. Does it meet the 50% test? It does, because the passive assets are only 26%. So you're fine there. But do you meet the 10% test? No. So this practice, unfortunately, if you're looking to sell the next day or tomorrow, you'd have to do something in order to get down to that 10% level. Okay, so what do we do? Good question. When the PC falls offside the 50% and 10% test, there are a couple of things you can ultimately try. First off, if you have any business debts, payables, here in this particular case, it was the CEBA loan, you want to make sure you pay those off. If there was money owed to the shareholder, you want to pay that down as well too. If you're looking at acquiring some assets, maybe, you know what, you're thinking of putting in a new chair or maybe acquiring a Serac machine or whatever it takes to bring you underneath that level, then you can go ahead and do that. My colleague Chris spoke maybe a month or so ago about IPPs. And if you establish an IPP, you have the ability to contribute towards this. And this is ultimately your own pension plan that's funded by the corporation. It doesn't show up on the balance sheet, which is a good thing, and ultimately becomes an expense of the corporation. And sometimes the amount of a contribution level could be significant to ultimately bring you down in terms of your 50% and 10% tests. You can pay out bonuses. You can pay out dividends. Maybe there's some CDA that's built up, because we talked about the CDA that was available on the sale of the goodwill. But if you also have an investment portfolio building up in your corporation, maybe speak with your advisor or speak with your accountant. There might be some capital gains that you've paid tax on the portfolio that's created this CDA account. Because you remember, 50% of a capital gain is not taxable and it goes into that account. So you may have some hidden gems and the ability to draw out some money. And ultimately, the last thing that happens, if you've exhausted all the other four and you say, okay, you know what, I don't really want to take this money out to bring it down to within the 10%, because I don't want to pay tax at the dividend rate today, you go through a reorganization process. And we'll sort of talk a little bit about the reorganization process in the next few slides. One of the things that I'll mention that is also important is when we talk about bringing the asset value or the passive asset value down to 10%. So in this particular case, the purchase price or sale price was about $1.5 million. So we don't necessarily have to bring all the bank down to zero. We can ultimately bring it down to that 10% level at $150,000. And what that does is ultimately allow you to take the money out of this corporation as part of the sale price, and you're paying capital gains rate on that $150,000 and not a dividend rate if you want to put all that money out before and clean out your bank account. It's no additional cost to the purchaser, because ultimately those proceeds are going to come from the bank account that's already there, and it's just going to pass on to the seller. So when we talk about purification and we talk about keeping it clean, it's important to look at the structure and how your professional corporation is ultimately set up. The RCDSO, when they allowed corporations for professionals, especially healthcare professionals and dentists, there were certain rules to follow. And one of the main rules is that the owner or the dentist had to be the only voting shareholder. So if there's a husband and wife team dentist, both can be voting shareholders, but spouses, children, and parents can also be non-voting shareholders. And that, previous to our favorite liberal regime, the rules were such that you were able to benefit to pay out dividends to parents and adult children, ultimately fund some education post-secondary, but the rules changed a few years ago, where unless the children are actively involved in the business, it's harder to pay out dividends. And one of the things that's important to know on your structure and the type of shares that are held by the individuals is whether these shares are growth shares or participating shares. As the owner of the practice and having voting common shares, those are growth shares, meaning that the value of those shares increase with the overall practice value increase. If you have a spouse or a child that owns non-voting shares, these non-voting shares can be participating or non-participating. And when they're participating, they're able to participate in the future value and growth of this practice. So when we talked about the multiplication of the capital gains exemption, in order for them to participate, they have to have growth and participating shares. So that's very, very important. And speak with your lawyer, because the ultimate setup of these structures were done a number of years ago. And a lot of the times they were set up mainly just to allow kids to and parents to receive dividends. And they had non-participating shares. They were calling sprinkled shares or dividend only shares, but they didn't have any growth value. And you can eliminate those shares relatively easy without any major ramifications to the main shareholder. You know, it's great to have family members as shareholders and the ability to multiply the $900,000 capital gains exemption across the board. It's just fantastic. In this particular case, you know, husband, wife, children, there could be potential 900,000 times 3, 4, or even more shareholders. And that's a big amount of tax-free dollars. However, what you need to be mindful of is when these people own, and the kids and the parents own growth shares, they own a piece of your company. And that comes with some bad as well too. If you have a child or you have a parent that may be going through their own, whether it's a marital situation or maybe a business situation, and it's determined that they have ownership of your professional corporation, then there is some exposure there. And ultimately, you may find that your shares may have a detrimental effect when you end up having a family member. It's all great and good when we all love each other and it's one big happy family, and sure, we can multiply 900,000 by 4 or 5. But unfortunately, we've all been privy to stories that have come back to haunt. So just be mindful, right? And they do receive the proceeds on the sale of the practice. So if you have a 19-year-old or a 20-year-old and they own a share of the corporation, upon the sale, that money needs to be paid out to that particular shareholder. I know we love our kids, but funnier things have happened. Anyway, we're going to go through a bit of an example where we get our Dr. Smith once again, who has a practice value of about 1.5 million. There's about $500,000 of passive assets. So as we say, he doesn't meet the 10% test, but he does meet the 50% test, which is good. So if he wanted to sell, he could, but we'd have to go through a reorganization process in which we ultimately have to transfer those passive assets out to another corporation, to either a holding company or another professional corporation. So in this particular case, Dr. Smith had the initial $100,000 of common shares, which were the voting growth shares. The spouse, unfortunately, when they were set up, did not have the growth shares. They were Class C special shares, were just basically sprinkling shares, which were shares that allowed to pay out dividends. And in addition, when the corporation was initially set up and there was a rollover to roll some of the assets in, there was some special shares that were taken back by the dentist that maybe had a value of $300,000. So we go through a bit of a reorganization between accountants and lawyers that work together. We establish another professional corporation. This could be a professional corporation. This could be a holding company, could be a number company. I'll sort of explain why we like to use the associate company and not a holding company per se. In this particular situation, the restructure occurs. We pass over the $500,000 of assets to the associate corp. You'll see that they have now 5,000 Class A shares. Dr. Smith's value of the practice is frozen at 1.5 million, which is the value of the practice today. So Dr. Smith's spouse, who didn't have growth shares, cannot utilize the capital gains exemption on that 1.5 million because she was not a shareholder of a growth nature at that time. So the first, on the sale of potentially $2 million, the first 1.5 million gets allocated to Dr. Smith. And then any future growth, as you see, we then have an inequity of one class of common shares to Dr. Smith, which are the voting shares, but then 99 growth shares to Dr. Smith's spouse. So then the future appreciation, let's say it grows to 2 million or 2.5 million, then ultimately that growth beyond the 1.5 million is then able to be allocated a majority to Mrs. Smith, and she could use the ultimate capital gains exemption. All right, so hopefully not too complex. The reason we like to use the associate corporation and not a holdco is as time progresses, and if the sale does not take place and you want the value of this practice to grow beyond the 1.5 million, and maybe a couple of years later you want it to be worth 2 million maybe, we like the services agreement between the two corps. It allows us to pass fees from one corporation to the other and ultimately keep the operating PC as pure as possible. So that's the term purification and keeping it ultimately pure. All righty, Bill C-208. I think in the summertime, there was proposed legislation that ultimately passed relatively quickly that was introduced by the Liberals, and I think they had some support from the Conservatives as well, where they wanted to be a fair treatment of transferring a business from parent to child. Currently, there's been an inequity where if a son or a daughter wanted to take over mom or dad's practice, ultimately the capital gains exemption wasn't truly available without making it detrimental to either the buyer, because they couldn't use a corporation to purchase the shares, and ideally that's what you wanted to happen. So instead of capital gains treatment, it became dividend treatment. So instead of 25%, it was potentially up to 47%. So that was a huge inequity. Whereas if they wanted to sell it to their neighbor and not their child, that they were then able to use the capital gains treatment and the capital gains exemption. So it was truly unfair to have this business pass on to the next generation. So they introduced some legislation that ultimately will allow for a family member to acquire the shares of the professional corporation and utilize their own corporation to purchase it and take advantage of the capital gains exemption and utilizing the corporate dollar to pay down some of the debt, let's say, that was required to pay out mom or dad. There were a couple of rules that are still being worked on. There was some scuttlebutt that legislation came out relatively quickly, and people were jumping on it and saying, oh, you have to do this before November 1st. You know what? The spirit of the legislation was such that, you know, you wanted to be able to have a child over the age of 18 to control, to be part of the practice, to actually hold those shares for a 60-month period. So there are a couple of things, and there's still some tweaks happening. And they're expecting by early part of January, the government is going back into Parliament, I think in the middle of this month, I think the next week even. These are probably one of the things that'll be discussed, and maybe more specifics regarding the sale of practices and intergenerational transfers will be more addressed. And I think two great advantages to our young dentists that hopefully have the abilities to continue on their parents' legacy. All righty, question 2, Carla. So who can be a shareholder of the corporation? Spouse, parents, children, or the one and only all of the above? Look at that. Numbers are coming in. A very, very attentive group. Excellent. 100% answer. D, all of the above. So that's great. Thanks, Carla, for that. And I'll just end those results. All righty. So the numerical part of the presentation is over. So we only got a couple more minutes that I'll have the presentation continue for, and then we can open it up to some Q&A. But some factors, because it's not always about the numbers. Numbers are a big part of any sale. However, as we've come to appreciate, and many valuators will tell you that there are other factors to consider when looking at a practice sale. Full sale or partial sale. You know, we have situations where we have associates that have been with the practice a couple of years, and there is the intent of ultimately selling the practice to that associate, but maybe not right now. And there's a chance of owning partial ownership, 25% or 50%. So there's a way of structuring the deal where you have the ability to keep the associate happy, keep the vendor or the practice owner happy, where you have committed associates to working in the practice, and then ultimately you can work out numerical numbers and how the future sale will take place, whether it'll be a 2, 3, 4, 5-year buyout, what the price may be at that time. Will it be based on the current valuation? Will it be a future valuation? Those are all things to consider. Leases. The most important part of any practice sale, especially if you don't own the building, is the lease that you have for your premises. Banks, especially if you're selling to a third party that is not corporate, even if it's corporate, banks will want to see at least a 5 + 5, a 10-year renewal, if not longer, maybe 12 years, because banks are lending over a 12-year period now as well too. So making sure you have a strong lease with a lot of renewal periods, hopefully no demolition clauses. We're hearing more and more stories of landlords renegotiating and introducing demolition clauses just because it provides them a flexibility down the road to be able to get out themselves. So you got to be mindful. I was talking with a dentist last week, and their landlord introduced a demolition clause. However, the dentist was able to negotiate a period, a good 12-year period, where they could not demolish. So that provides some flexibility for the buyer and the seller. Employment contracts, can't stress it enough. If some of you have had the opportunity to, I think, listen to a couple of seminars, many lawyers, especially post-COVID, are very, very insistent on making sure that contracts are established for the practice. What it does is it sets at least some groundwork for the future owner. Doesn't mean that an employee cannot sue you. Anyone can always sue you potentially, but it establishes groundworks, establishes responsibilities, duties, vacation schedules, maybe time off, wage increases, different things. And more importantly, it also establishes a, we'll call it a severance, or what they're entitled to, maybe beyond the Employment Standards Act. Equipment leases. If you are a practice owner that likes to lease a lot of their equipment, at the time of sale, those equipment leases have to be bought out. So that becomes a cost borne upon the purchaser to buy out those leases. So if you're, 1 year into a 5-year lease and you're looking at selling the practice, there might be a big obligation that you have to pay out in order to convert that lease, because the new owner will not take on that lease. Transition, especially if it's a non-corporate sale, transition is important. As we know, attrition and patients leaving are always potential with a change in ownership. But the owner sticking behind and working within the practice to help transition the new associate is vital to the future growth and the viability of the practice. And a little shameless plug here, if some of you may or may not have seen it, if you visit our website, or even if you YouTube TMFD YouTube channel, you'll see that my colleague and I, Chris, did a 6-part series on preparing your dental practice for sale. It's a bit of soup to nuts, from getting your practice ready to some numbers, to transition, to dental brokerage, a lot of interesting information. And we were fortunate enough to have one of our clients as the narrator, Dr. Diston, and we thanked him tremendously for helping us out. So he did a fantastic job at guiding us along the way. All right, last little plug for the book. If you haven't already done so or would like to have a copy, please visit the website, order it, and we'll be happy to send it out. That's the end of my presentation. If there's any questions, we'll stick around. Gary, if I think I can see.
Yeah, Steve, I can read it to you, or if you can see
Let me
it.
just quickly
We
go
have
to the
one.
Q&A. Yeah. Okay. When determining future sale to associates, say in 5 years, often there is a disagreement as to associates' contribution to the valuation. Can you address this from both the associates and from a principal dentist perspective? Fantastic question, Tony. I just had that comment the other day where I was in a room with 2 dentists looking to ultimately come together, but the selling dentist wasn't interested in selling 100% of the practice and looking to transition over potential, as you indicate here, maybe a 5-year period. And that question came about saying, well, I've now come into the practice as an associate. I'm bringing other services into this practice. I'm building up the value of this practice. Is the value going to be redetermined in 5 years? And that, you know what, is an interesting question. And I guess something that's negotiated, Tony. It's not a cut and dry thing, unfortunately. You know, a lot of times I think that each party benefits from the associate coming in. Let's say they're bringing in other skills and adding to the bottom line. Not only is the associate making more money, but they're also receiving additional profits as well too, because they're now a 25 or 50% owner. So maybe the valuation and the buy-in is based on the original practice price that was done 5 years prior, or the time of initial sale. So hopefully that answers it, Tony, but I apologize for being not 100% on that one. Any chance the government can take away the capital gains exemption? Good question. I hope not. You know what, Scott, that is something that everyone asks. And my personal opinion, I don't think that they're going to take away the capital gains exemption. What I think they may do, as we've heard, they may increase the capital gains rate from 50% to maybe 2/3, 66 or 75%, which was back a number of years ago. I could see that happening before they take away the capital gains exemption, because that's sort of the last little hurrah that most business owners still have, along with the principal residence exemption, which there's talk of that potentially being taken away. But they have to raise money somehow, that's being said, that to pay for a number of these benefits that have gone out. So anything's a possibility. And should I have a prelim before marriage to protect the clinic from my spouse? Yes. Yes, and yes. I suggest you speak to a family law lawyer and definitely inquire, but you just have to be careful. I'm not a family law lawyer, but assets that have been acquired up until you know, your marriage always belong to the individual. But if you get married and years go by, it's a lot of joint assets, and family law may put you behind the 8 ball a little bit.
I'm not a lawyer either, but you don't present that to your spouse the day before you're getting married as well. That would be a problem. But it's, yeah,
Well, I agree, Gary. Thank you.
Steve, I don't see any other questions coming in.
Okay, no, that's great.
So, Steve, most importantly, your Leafs are up 1-0 as of
Very nice, very nice. A Daryl Skittler score?
I don't know. Okay, we have a question, Steve. Actually, we
Okay,
have a question.
okay.
So let's do that, and then we'll wrap up.
If you have a dentist and a spouse, both as shareholders, set up properly. Yes. Okay, I suspect would they qualify for the capital gains exemption? Assuming all the other answers, all the other questions have been answered in terms of the purification and they meet the test, then yes, both spouses would qualify for the $900,000 capital gains exemption and ultimately get some of those proceeds, or at least $900,000 each, as long as you sell for that much. I suspect that was that the question? I didn't see the bottom of the question. Maybe I didn't see it. Oh, yes, you're right. Then you do qualify. But only if you sell the shares of the corporation. So the last part of the question was, so do you then pay tax when you remove from the PC? So you don't sell the assets, you sell the shares and they take over your corporation and you receive those proceeds personally. That's where you get the $900,000 exemption each. Hopefully that answers the question. All righty.
Thank you both for content and for, oh, it looks like there might be one more.
Might be another one here. Okay, no problem. Let's see if I scroll down here. Maybe, Kevin, you might sell your practice before, my friend.
The question, others cannot see the question, I believe.
Oh,
So the
sorry.
question is,
Will the Leafs win the Stanley Cup this year? I thought so last year, my friend, but I didn't think, I don't know. No is the answer.
Okay. Steve, thank you both for the content and the presentation style, which was exceptional. I know everyone got a lot out of it.
Yeah,
And
no
I see comments coming in saying, well done, great job. So thank you so much, Steve.
Okay.
We want everyone to stay tuned over the next number of weeks and we'll get out our schedule for the TMFD Academy webinars for 2022. I've seen a tentative one. There's 8 dates on it. So we look forward to seeing that confirmed. And Carla, just before we say goodnight, you were going to comment on the CE credits for this.
Yes, thank you, Gary. So I will be sending out an email over the next couple of days. First off, just to ask everyone for their comments and feedback on tonight's webinar. So we welcome any comments you have or any suggestions for any topic ideas that you'd like us to consider for the coming series in 2022. And also, I will be sending out an email personally to everyone with their CE credits by December 3rd. So just roughly in about 2 weeks, you'll all have an email from me with your CE credits. So thank you all for attending this evening. It's a pleasure having you here. Thank you, Steve and Gary, for hosting this evening. And we hope to see you again in 2022.
Go Leafs, go.
Go Leafs, go.
See, good night.
Good night, everybody.
Good night, everyone.